right, Joe. Hey, thanks for coming in today. Really excited to see what you have to say.
Awesome. Thank you for having me.
Yeah. All right, let's jump in.
Sure, sounds good.
All right. So your client is the CFO of Aperture Laboratories, which is a leading U.S. biopharmaceutical company with a market cap greater than $150 billion. Now, Aperture develops and manufactures a diversified range of products, and in particular, it prides itself on saving millions of human lives every single year. So the company is under investor pressure because of its slow projected firm value growth over the next 10 years. So investors are very anxious to see a significant change announced at the firm in the next quarter, or announced by the firm. Now, the CFO has already identified and evaluated a number of high-growth, promising, but also capital-intensive projects, and she does not have enough cash to invest in any of these opportunities. What does she do next?
Awesome. Thank you so much for that. Definitely interested in this problem. It's unique. There's a lot of different elements I'm seeing here. I just want to recap really quick before we jump forward. So our client is the CFO of Aperture Labs, which is a U.S. biopharma company with a market cap greater than $150 billion. They're highly diversified and sell many different products. You hit it, and I wanted to make sure I caught this because you said most importantly, they pride themselves in saving millions of human lives every year. Currently, they're facing investor pressure, wanting to see significant firm value growth in the near term. But the CFO has identified multiple projects which could achieve that means. However, she does not have any capital to be able to pursue those projects. Is that fairly a sum up the?
You got it.
Awesome. A few questions for you. You mentioned diversification and diversified. Is this just a single brand with multiple product lines, or is it individual business units within kind of a corporate hierarchy?
Yeah, so I think you can imagine kind of almost individual business units, I think, within that hierarchy. So they might produce very different sorts of things.
Gotcha, gotcha. The second question I have with regards to investor pressure, is our client a publicly traded company or a privately held company?
So you can assume publicly traded.
Okay, and then you mentioned within the next quarter. Is that the only time-specific things? Are they looking for more of to see action or to see actual results within the quarter?
Yeah, I think results would be great, but they do want to see some sort of action addressing that core question within the next quarter.
Awesome. If you don't mind, I'm just going to take a moment to gather my thoughts.
Please.
Okay. When I think of this, there's a lot of different things going on with this problem. It could be easy to go down the rabbit hole to try to maybe find some other projects, but assuming that the CFO is a very intelligent individual and has already identified these projects, I'm pretty sure that's not the problem we're looking at. So what I see as the problem is we need capital, and that's something we need to look forward to. There's a couple different ways you can go about this. You either have cash flows from financing, cash flows from operations, or cash flows from investing. Speaking from financing, what we're looking at is either debt financing or equity financing. Debt financing is very attractive because it's cheap capital. Yes, there's going to be interest payments that are associated with that. However, there is a tax shield that is associated with it as well. The downside with this is, given the low growth and not having cash on hand, that to me is an indication of potentially low free cash flows. So the ability to maybe service that debt in the future is a risk that we may not be able to take on. I would have to dig into the current financials in order to determine if that's the case. The next under financing is equity financing, which would essentially be receiving additional investors, issuing new stock options, or otherwise raising equity financing that way. It's good because it's very quick. We could easily get that cash infusion to be able to fund these projects and to grow the firm. The problem we have with that goes with the nature of this problem that we're having is the investor pressure. Typically with a seasoned equity offering, that will signal to the market that our stock price is currently overvalued, which may spurn a sell-off on the market, which if we think we're facing investor pressure now, that might be a bit of a problem. Additionally, the pro rata share of the residual cash flows that comes with being an equity holder would be decreased as a result of issuing new offerings. So I want to stay away from the equity piece if at all possible. Moving over into cash flow from operations, this would just be essentially increase revenues, decrease costs. But as I mentioned, my assumption right now is that those free cash flows right now are very marginal and they're not going to be able to allow us to increase revenues or decrease costs through various programs, as it takes money to make money, and right now we don't have any. So I think we're going to steer away from that. The third option that I'm looking at is the cash flow from investing, which is effectively what I would call the yard sale solution. The yard sale solution would be we either need to sell fixed assets, sell a line of the business, divest ourselves of a portion of the company to be able to rapidly spike that inflow of cash. This is good because not only would it allow us to become a little bit more leaner and lower our diversified focus. As you mentioned, we are diversified. We may be too diversified, but definitely need more information to determine that. The second piece with that is it may take time. Depending on what we're trying to sell, there might not be a market to sell it to, which if we're looking for those visceral spike within this quarter, that might not meet that time horizon to get the CFO where she needs to be. My hypothesis is that I would think we want to look into the debt markets, as debt is something that we can get cheaply and fastly, and it will enable us to finance those projects that the CFO has already identified. That would be the place that we would want to start. So based off of that, do you have any information, financials from the firm right now to look at to determine their leverage ratio or what the impact of that could possibly be? So
we don't have any of that information, and we also know the CFO isn't really looking to take on additional debt at this point, so I would try to stay away from that.
Okay. So based off of that, debt's out. I'm going to continue to steer away from equity, as the downsides with that I don't think are good unless it's a last resort. So I'm also going to steer away from ops unless there's something that you think that's relevant that we should look into there, just because my assumption is there's no free cash flow there and we're not going to be able to get what we're looking at. Is that a fair assessment?
Yeah, I think that makes sense.
Okay, that brings us to the yard sale contingency. So I'm curious, do you have any information on what those business lines look like, of what is our current product line and product offering to determine if there's any that are posed for divestment?
Yeah, we do have some of this information.
Beautiful.
Let's take a look at this exhibit. Tell me what you're seeing.
Awesome. Do you mind if I take a second to just kind of digest this?
Please.
Okay. Okay. So what I'm looking at here is effectively they got the 5-year CAGR on the one axis and increasing specialization requirements on the right, with the size of the bubble representing the effective size of sales of that business line. And I'm assuming these are those independent business lines that you mentioned earlier.
Exactly.
A little curious if I can get some clarification with regards to specialization. When I see increasing specialization requirements, what that tells me is just it's very detailed, very specialized. It takes a unique skill set or a unique set of equipment in order to produce these products. Is that a fair assessment?
Yes, I think that's fair.
Okay. The reason I ask that is I would assume if it's specialized skill set or specialized equipment, there is few individuals or few firms out there that possess the requisite equipment and personnel to be able to do that, which tells me there's not much of a market to sell it to.
It's a good insight.
So based off of that, I'm not a big fan of divesting a lot, just because you can get on a roll and end up selling way too much of your product. So I'm going to work on these one at a time, and then depending on where we get, we'll come back and see if there's a second line we want to divest from.
Please.
My eyes are immediately drawn to the animal health business for 3 reasons. The first is the 5-year CAGR. Other than established products, the animal health has the lowest growth rate right now. And as we're looking for firm growth, that's something that I think we'd want to look at and maintain our high growth markets, because growth is something we're looking for. The second is specialization requirements. It is the lowest on the specialization requirements, which to me says there's probably the largest market of customers that we could sell it to, which means we could sell it quickly and get a fair price for it, as there's going to be significant demand, I would assume, given its size of $4.2 billion in annual sales.
Yeah.
The third goes back to that interesting piece, and I caught it in when you shared the problem, is the focus on the saving of human lives.
Yeah.
All of these products, to include oncology drugs, primary care, they're all focused around human wellness, except that one. That one to me is a little bit kind of outside of the core competency and the scope, so I think by divesting animal health, we would be able to focus more on our core competency of saving human lives, and it would be a little bit potentially reducing additional costs, given that it's a completely different market segment we're getting after.
Yeah.
Next step would be to determine what can we sell it for. Do we have any information on the free cash flows or any discounted cash flows model to determine the valuation of what we could maybe sell this for?
Yeah. So it's interesting that you picked that one, because the business development team has actually retained JP Morgan to assess the sellability of this animal health business.
Oh, awesome.
And they've identified that Aperture will likely receive 3.5 times enterprise value to sales multiple for the animal health business.
Okay, that's very convenient. Multiples models are definitely
Very
a lot
convenient.
easier to work with than discounted cash flows. So my assumption with that, just going forward to structuring, is we would get a sale price of just effectively sales, which would be 4.2 billion times 3.5. Is that a fair?
Very simple, very
awesome.
straightforward.
So I'm going to just quickly do that math, which would be the 4.2 times 3.5, which would be 10, 21, 6, 12. That's giving me a sale price valuation of $14.7 billion. Now with that, obviously the sale of a fixed asset comes with some capital gains implications there. Do we have any information on what the effective tax rate could potentially be?
So JP Morgan actually did a good job, and they've been able to structure this to be tax-free.
Oh, really? Okay. So right there, we were able to free up $14.7 billion worth of capital.
Yeah.
So that being said, you mentioned that the CFO had already identified capital-intensive projects. Do we have any information on what those are and what they're going to cost?
We do.
Oh, very nice. Okay, do you mind if I take a second to look at this?
Please.
Okay. So what I'm looking at here is we have 1, 2, 3, 4, 5, 6 different potential NPV positive projects. With regards to capital investment required in NPV, generally when I hear NPV, it's present value of the investment minus whatever the initial CapEx was. Is that fair to assume here as well?
Yeah, so you can assume that this already includes.
Okay, so with the 3 and 3, that's not a net zero, that's a present value of $6 billion as opposed to with 3 of additional value add.
Yes,
so all of these are value adding. Awesome. So looking at the capital investment required, obviously with 14.7 billion, we can't spend all of it. We can't do everything.
Yeah.
So we're going to have to pick and choose what we're looking at. What I could do is just to determine, it's a little bit unorthodox and not necessarily precise, but what I could do here is get a ratio of NPV per CapEx to determine which are the most capitally efficient projects, and then kind of work from top to bottom there to determine which ones we should buy to get the most NPV for our spend. Does that make sense?
Yeah, I think given the information you have, that makes a lot of sense.
Awesome. Do you mind if I write on this?
Please.
So looking at this, we have an 10 NPV to $10 billion NPV to a $9 billion capital investment required. So looking at that, we're going to see, actually, I want to go over here. So it would be NPV times CapEx. So it would be 10 divided by 9, which would give us 1.11, I guess, value for every dollar we spent.
Yeah.
A little bit unorthodox, but we're going with 1.11.
Yep.
Moving down to the acquire a newly approved GL1P agonist. I'm curious to what that is, if you have any information, but we'll get there a little later.
Yeah.
So we're going to have NPV of 10 divided by 6. So that would give us 1.6. $1.66 per spend there. We're looking at 7 divided by 5, which would give us 2. 4. 1.40. And we got 5 divided by 4, which would give us 1.25. Next would be 5 divided by 3, which would give us 1.666 again. And the last one would be 3 divided by 3, which is a flat 1.
Yep.
So looking at this, the two that are sticking out from a ratio perspective that are the most capitally efficient would be the acquire the newly approved GLP-1 agonist and the cost-cutting initiative within the United States. Those would give us the most value capture for our dollar spend based off of this projection. Looking at a capital expenditure of doing both of those of $9 billion. So if we have 14.7 minus 9 billion, we're looking at, we still have $5.7 billion left to spend. So those ones I think would be the most capitally efficient.
Yep.
Moving on, the next in order of efficiency would be the research the new formulations for existing product portfolio at 1.4, which would cost $5 billion, which would leave us with 700K. Effectively, that is what we'd be able to do.
And what would you do with the 700K? Any ideas?
So this goes back to the nature of the problem itself, right? $700,000 is a lot of money. So there's really 3 things we could do with it. One, we could keep it and have more of a cash reserve for the future in case one of these things comes up or any of these projects are a little bit more expensive. The second would be to directly address the investor pressure, would be the nature, the ability to do that. So one thing we could do is issue a dividend to our shareholders. One way to get shareholders to be a little bit less anxious for growth is to put money back in their pocket, allowing them to invest elsewhere. The second would be to do a share buyback. As I mentioned earlier with seasoned equity offerings, if you issue equity, it signals to the market that you're overvalued, causing a sell-off and a price drop. However, if you do a share buyback, it signals to the market that you're undervalued, which may trigger additional demand in your stock, which would drive the stock price up, which all investors would like to see the value of their stock increasing. So any of those 3, I think, would be a very good option to use that 700K.
Yeah, very fair.
Assuming that, let's see, we would end up getting 10, 15, plus 7, $22 billion worth of net present value of this. Assuming if that's a large enough splash for the CFO to make in order to solve this problem, I think I'm ready to make a final recommendation.
Feels like a pretty big splash to me.
Okay.
Yeah. What's your recommendation?
So obviously the problem is to raise money. In order to do that, I would recommend that the CFO divests Aperture Labs from the animal health business in order to gain $14.7 billion and then further invest that $14.7 billion into acquiring the newly approved GLP-1 agonist, to research new formulations for existing portfolio, and to initiate the cost-cutting initiative for our U.S. manufacturing plants. That would enable us to achieve $22 billion of net present value add, which would cause the value of the firm to grow rapidly with this announcement. A couple of risks associated with this that I want to make sure of. First, that 3.5x sales multiple. Obviously, that is the assessment right now. We need to be sure that that is accurate because the ability to actually receive that price and in actuality, get it is rare. So I want to make sure we do our due diligence to see if we have the appropriate purchaser for the business unit and also that the deal goes through rapidly and expediently, because obviously we know M&A can maybe sometimes hit some friction and take longer than we'd otherwise anticipate. The second risk that I would want to be concerned about is how long these projects are going to take to implement. Obviously, for a $6 billion spend and $10 billion in net present value, that is a very nice value to generate. However, when are we going to see those gains? Obviously, the announcement of these projects should be enough to get the investor pressure off of the CFO. However, if this is a 5, 10, 15-year slog, as opposed to a rapid spike in firm value, that might not necessarily do the trick. So I'd want to be sure that we're accurately forecasting the timeline of these projects to make sure that they're implemented in a very sequenced manner to get the short, easy wins first, and the larger, more capital-intensive projects in the pipeline to generate that value as quickly as possible. To mitigate this with next steps, I would definitely want to maintain working with JP Morgan to determine and isolate a buyer for our animal health business to immediately get that deal structured so that we're able to announce within the quarter. Additional next steps, I would want to do additional due diligence on these projects to get a specific timeline so that when the CFO does make the announcement within the quarter to shareholders, there is a timeline to when this value add will be actually recognized so that they're well aware. Additionally, I would immediately, upon announcements, pair that with the announcement of what we're doing with the 700K, which I would recommend doing a share buyback, which would eventually appease everyone involved and hopefully make investors happy.
Well, that made me very happy. That was great. Thank you for your time.
Hey, thank you. Appreciate it.